Going on, everybody? What's going on? What's going on? What's going on? Again, I appreciate everybody for coming back and tapping into another episode of the Trade for Yourself podcast. There was a big interest rate decision that was given today, and that's what we are going to focus on today. We're going to focus on the fact that interest rates control the stock market. And so we're going to talk about what Jerome Powell and the Federal Reserve did today. So I don't want to waste anybody else's time. So please, again, welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade and invest in the stock market for yourself. So make sure that you please like and subscribe to this. Okay. Please like this. Please subscribe to this channel. Okay. This is really going to help me in the algorithm and help me to get out to so many different people. We are coming up on the end of 2022, and I appreciate everybody for the support that has been coming back to me every single week, listening to what I have to say about the stock market. Okay, so let's go ahead and get into this. Let's talk about what happened in the stock market today and what was the big news that was reverberating all across the news outlets. Okay, so the Fed raises interest rates a half of a point to its highest level in 15 years. Okay, and so the Fed had been raising interest rates by 75 basis points 4 times in a row, but they decided to bring it down by 25 basis points and only raise by 50 basis points this time, because they said that they've done so much tightening already. And we're going to get into what all of that means. Now, Federal Reserve on Wednesday raises benchmark interest rate to the highest level in 15 years, indicating the fight against inflation is not over despite some promising signs lately. Keeping up with expectations, the rate-setting Federal Open Market Committee voted to boost the overnight borrowing rate half a percentage point, taking it to a target range between 4.25% and 4.5%. The increase broke a string of 4 straight three-quarter point hikes, the most aggressive policy move since the early 1980s. Along with the increase came an indication that officials expect to keep rates higher through next year, with no reductions until 2024. The expected terminal rate, or point where officials expect to end the rate hikes, was put at 5.1%, according to the FOMC's dot plot of individual members' expectations. So what this means is that we've still got some more time to go before we get to that peak terminal rate. And, interest rates are going to continue to be restrictive, okay? And when I say restrictive, economic conditions are going to continue to tighten. Borrowing costs are going to be larger. These things are going to continue to affect the economy. And the Federal Reserve admitted that the effects from all of their rate hikes have not been seen yet. So the worst of what we expect to happen in the economy due to these rate hikes has yet to be seen. Now, investors initially reacted negatively to the expectation that rates may stay higher for longer, and stocks gave up earlier gains. During a news conference, Chairman Jerome Powell said it was important to keep up the fight against inflation so that the expectation of higher prices does not become entrenched, okay? Inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases, the chair said at his post-meeting news conference, but it will take substantially more evidence to have confidence that inflation is on a sustained downward path. We have got some good CPI numbers over the last couple of months, but the Fed wants to see market improvement. Okay, like they want to see a good report for December. They want to see a good one for January, a good one for February, a good one for March by the next time they release another summary of economic projections. Okay, so they can kind of make a better determination. Now, this chart right here shows us the federal funds target rate since July 2006. Okay, so we're expected to get up here to where we were in 2007, which is around 5.25%. We're expected to get up around there. So we're pretty close. But as you can see, 2007, 2008, That was during the great financial crisis. So rates were cut, and they were kept at about zero for years. And then the Fed started raising interest rates in 2016, 2017, 2018. And at the end of 2018, early 2019, they paused the interest rate increases and then started coming back down to cut them again. Now we're back on the tightening cycle again because we have to get the inflation down. This is very, very important. Now, the new level marks the highest the Fed funds rate has been since December 2007, just ahead of the global financial crisis. Like, are they reading my mind here? And as the Fed was loosening policy aggressively to combat what would turn into the worst economic downturn since the Great Depression. This time around, the Fed is raising rates into what is expected to be a moribund economy in 2023. Moribund, like think about that use of wordplay, moribund. Members penciled in increases for the funds rate until it hits a median level of 5.1% next year, equivalent to a target range of 5% to 5.25%. At that point, officials are likely to pause to allow the impact of monetary policy tightening to make its way through the economy. The consensus then pointed to a full percentage point worth of rate cuts in 2024, taking the funds rate to 4.1% by the end of that year. That is followed by another percentage point of cuts in 2025 to a rate of 3.1% before the benchmark settles into a longer run neutral level of 2.5%. So as we can see here, the plan is for the committee to get more restrictive, right, to curb inflation. Once they feel they have curbed inflation to a sufficient level, they are saying they expect to begin cutting rates over time, 2024, 2025, and pretty much having another level of quantitative easing in a way and making monetary policy more accommodative. Okay, but they're saying that will not happen until after the inflation war has been won. However, there was a fairly wide dispersion in the outlook for future years, indicating that members are uncertain about what is headed for an economy dealing with the worst inflation it has seen since the early 1980s. So as you look at these projections are not set in stone. They are not set in stone. It's only based on what we see currently right now at this specific moment in time. Now, the newest dot plot featured multiple members seeing rates heading considerably higher than the median point for 2023 and 2024. For 2023, 7 of the 19 committee members, voters and non-voters included, saw rates rising above 5.25%. Similarly, there were 7 members who saw rates higher than the median 4.1% in 2024. The FOMC policy statement approved unanimously was virtually unchanged from November's meeting. Some observers had expected the Fed to alter language that it sees ongoing increases ahead to something less committal, but that phrase remained in the statement. Okay, so they're saying that rates will continue to increase. Fed officials believe raising rates helps take money out of the economy, reducing demand and ultimately pulling prices lower after inflation spiked to its highest level in more than 40 years. The FOMC lowered its growth targets for 2023 as well, putting expected GDP gains at just 0.5%, barely above what would be considered a recession. That is not a good outlook for what the economy is expected to do next year, guys. The GDP outlook for this year was put at 0.5%. In the September projection, the committee expected 0.2% growth this year and 1.2% next. The committee also raised its median estimate for its favored core inflation measure to 4.8% for 2022, up 0.3 percentage point from the September outlook, and members slightly lowered their unemployment rate outlook for this year and bumped it up a bit higher for the ensuing years, okay? The rate hike follows consecutive reports showing progress in the inflation fight. So So pretty much what they're saying is that GDP growth is going to be lower than expected next year. The unemployment rate is going to be higher than expected next year. Inflation is going to come down, but it's not going to cause a recession right now in their base case. I believe anything could shift that thesis in any given direction. So I wouldn't put all of this stuff and just set it in stone. I would evaluate what the Fed says and then also evaluate what other banks see as 2023 stock market outlook projections and see what they look like, the people who actually have the money. Now, the rate hikes follow consecutive reports showing progress in the inflation fight. The Labor Department reported Tuesday that the consumer price index rose just 0.1% in November, a smaller increase than expected as the 12-month rate dropped to 7.1%. So year over year, inflation was down lower than expected, and month over month inflation was lower than expected, which is very, very good. Okay. Inflation is not increasing month over month, which is very, very solid. We need that trend to continue. Excluding food and energy, the core CPI rate was at 6%. Both measures were the lowest since December 2021, a level the Fed puts more weight on. The core personal consumption expenditures price index fell to an annual rate of 5% in October. However, all of those readings remain well above the Fed's 2% target. Officials have stressed the need to see consistent declines in inflation and have warned against relying too much on trends over just a few months. Powell said the recent news was welcome, but he still sees services inflation as too high. There's an expectation really that the services inflation will not move down so quickly, so we'll have to stay at it. He said, we may have to raise rates higher to get where we want to go. The same consistent flow, the same consistent messaging, okay? Central bankers still feel they have leeway to raise rates as hiring remains strong and consumers, who drive about 2/3 of all U.S. economic activity, are continuing to spend. And that's what's making things so difficult. If you talk to people, people will say, hey, I expect a recession to come, and I believe that we are already in recession. The problem is that the fact that they say that in their mind, that is not translating into their behavior, right? Their behavior is not reflecting a recession, but in their mind, they believe that they're in a recession because they hear it all the time, right? Non-farm payrolls grew by a faster than expected 263,000 jobs in November, while the Atlanta Fed is tracking GDP growth of 3.2% for the fourth quarter. Retail sales grew 1.3% in October and were up 8.3% on an annual basis, indicating that consumers so far are weathering the inflation storm. Like I said, the behavior has not shifted yet. Inflation came about from a convergence of at least three factors: outsized demands for goods during the pandemic that created severe supply chain issues, Russia's invasion of Ukraine that coincided with a spike in energy prices, and trillions in monetary and physical stimulus that created a glut of dollars looking for a place to go. After spending much of 2021 dismissing the price increases as transitory, the Fed started raising interest rates in March of this year, first tentatively and then more aggressively, with the previous four increases in 0.75 percentage point increments. Prior to this year, the Fed had not raised rates more than a quarter point at a time in 22 years, which makes this so significant. The Fed has also been engaging in quantitative tightening, a process in which it allows proceeds from maturing bonds to roll off its balance sheet each month rather than reinvesting them. A cap total of $95 billion is being allowed to run off each month, resulting in a $332 billion decline in the balance sheet since early June. The balance sheet now stands at about $8.63 trillion. So the Fed still has a lot of money, has a lot of power, and has a lot of capability on its balance sheet at the end of the day. And so right now, the Fed is going through quantitative tightening in two different scenarios. The first scenario is the quantitative tightening in terms of raising interest rates to make economic policy or monetary policy more restrictive, borrowing costs higher, things of that nature. Also by pretty much getting bonds off of their balance sheet, right? This is a mechanism that the Fed is utilizing as a tool on both sides. If we do end up going into a recession, the Fed is trying to give themselves some run rate, give themselves some ability and some room to buy up some bonds if they need to. So right now, they're letting the bonds roll off of the balance sheet right now because they don't need to pretty much bolster up the economy. They don't have to just step in and save the day right now. So what they're saying is that they're going to allow this process to happen to raise interest rates, to get bonds off of their balance sheet. That way they can have the tools necessary that they need to help save the economy in case the economy goes into a recession. And so pretty much the Fed didn't do anything that the market didn't already expect them to do, right? As far as the terminal rate, where we expect it to go, it's not any different from where we thought the market would do before Jerome Powell came and gave us this press conference. Now, Jerome Powell won't be speaking to us at an FOMC meeting in January. So the next FOMC meeting will be in February, and then we'll have another summary of economic projections in March. That will be the March meeting will be a very, very significant meeting because we will then see, okay, what does the Fed see in the economy? Is the Fed going to pause interest rates? Is the Fed going to continue to raise interest rates, right? By the time we get to March, can we say that we are in a recession? What is going on in the economy, right? So at the end of the day, we still have some uncertainty ahead of us that we need to pay attention to, right? But remember this, interest rates control the stock market, and we're going to need to continue to watch the Fed, right? The Fed has been a buzzword. The Fed has been a topic that we've been following, right? The entirety of 2022. Some of the same issues, right? Some of the same themes, some of the same things that we've been going through in 2022 are going to be the same things that we are going to need to pay attention to in 2023. The Fed, right? What the Fed is going to be doing around interest rates is going to be important. Inflation, where is it going? Where is it trending? Is going to be important. The housing market, the economy, you know, the war in Ukraine, supply chain shortages, COVID reopening in China, all of these things that have been ongoing in 2022, I promise you are then again going to reveal themselves again in 2023, right? And so we need to keep all of that stuff in mind. So that's pretty much all I have for today's episode. I really just wanted to go through what the Fed did. Okay, I wanted to talk about what the Fed did and what Jerome Powell and the FOMC committee decided to do in terms of interest rates, okay? Because that's very, very important for us to understand that. Next week, I really want you all to come back and see me next week, because next week, I will be doing a 2023 stock market outlook. I want to look at some of the themes that I see that the big institutions are saying for next year, right? I want to go through what BlackRock has said, what has JP Morgan said, what has Bank of America, what has Morgan Stanley said, you know, what has Charles Schwab said, what has these big institutional managers said about what to expect in terms of where the stock market will be in 2023. Okay, now, when I talk about this, the first thing I want to tell you is that I'm looking at this in terms of trying to get themes, in terms of specific trades and specific trade ideas that we may be able to utilize going into next year. But what I see in this outlook is not going to change my fundamental long-term portfolio and thesis, which is largely in technology and consumer discretionary, right? And some communication services. That's kind of where I see the growth at, right? I'm not abandoning my growth mindset, but what I do understand is that what worked in 2022 from a stock market performance perspective is probably likely to work well in 2023, because the exact same themes that we've been going through over this entire year are probably going to reveal themselves again next year. So come back again. Next week is going to be a big week. It's going to be a lot of information that we have to go through that I believe that we need to pay attention to, that can help us be very successful in 2023 and beyond. Again, thank you as always. Please make sure you like this. Please make sure you subscribe. And again, remember, don't pay for it. Trade for it. I'm going to tap in with y'all next.